Hey, what's going on, guys? It's Amir Baluch here with some education for you guys. A lot of people are worried about inflation, and as you'll see here soon, that's like people's number one fear in the next coming years. So, I want to talk to you guys about how to protect yourself from inflation, maybe beat it with some double digit interest with something that's asset backed. All right, just a disclaimer here. This is not a PPM or anything like that. Always check with your CPA or attorney whenever you take action on anything. So here's the truth about inflation. So, according to these people, inflation tears apart the whole fabric of stable economic relationships. It's a way to take people's wealth from them without having to openly raise taxes. And Reagan says it's basically just as violent as a mugger, frightening as an armed robber, and as deadly as a hitman. So, what are we going to learn today? What exactly is inflation? We use the words a lot, but not everybody knows exactly what it means. And how does it actually affect your wealth? How we're going to beat it? How promissory notes act as a hedge? And if you want to qualify, we'll tell you how to qualify to join in our opportunity. So, a little bit about me. Most of you guys already know me. My name's Amir Baluch, an anesthesiologist, part-time, full-time fund manager and wealth strategist. And I like to educate people with contributions in Forbes, Entrepreneur, Yahoo Finance. I worked at a boutique investment bank for half a decade, which is where I learned how to underwrite all these different asset classes. And I try to educate even more with, we're actually on our third book right now. So if you haven't gotten that, just email me. I'll see if I can get you guys a copy of that. So I learned a lot from the securities world before going all in on this. And before all this happened, it didn't start that way. And some of you guys might not know this, but so this is me when I was in the ninth grade. And because I look like that, I was a big nerd and not very social. And I spent most of my time studying math, which was my favorite class. You can see me with my calculus book here. And then I always thought, hey, let me be a doctor like my dad. And so I applied to medical school, but I didn't get in. And so I tried to start my first business, lost my life savings at the age of 21, moved in with my parents to see, what I was going to do while I reapplied. And then my dad went bankrupt, and we moved to a one-bedroom apartment for $250 a month. And I was basically staring at the ceiling fan, wondering, how am I going to get my life together, and how do I become an expert on personal finance so it doesn't happen to me down the road. And here finally we did, at least I got into medical school eventually. This is like on day one or something like that. Finished anesthesia in Miami, and as I grew my personal passive income and learned about finance through securities license and working with other mentors, I was able to travel the world a little bit more, spend time with my friends. And you see here I've almost got ran over by a bull in Pamplona. Luckily they missed me, but I made the cover of the newspaper that day, which was cool. Spent a whole month in Europe. That was just a few years ago. We're also able to give back to charity. This is me and my brother here after selling one of our homes in our development. And this is me where you can't see, there's a picture of my book here, where now we try to give back with some. And through his education, we've helped a lot of people. You guys can read this later or check out my LinkedIn. So here's pop quiz for you guys. Ignorance is, you kind of want to say it's bliss, right? Or maybe it's strength. I think maybe it's expensive. And so, but the investment in knowledge actually pays the best interest, which is why we're going to out for. And so how does inflation work? Well, here's an example with some coffee. So back in 1970, coffee was maybe a quarter. Now, if you go to any Starbucks, it's probably $3. And if you get the fancy ones, I know I've paid even up to like $8.50, depending on the size and what you want in it. But the actual intrinsic value of a cup of coffee, which is like maybe the caffeine you get into it, the flavor, the enjoyment you get out of it. That hasn't changed. That's not 10 times the value, right? The cup of coffee hasn't gone up in actual intrinsic value 10 times. It's kind of been the same. But why'd the price go up? Well, the price went up because the value of the dollar went down. And that's what inflation is. So when the value of the dollar goes down, even though you've been saving money in your 401k and you're making a little bit of money here or there with stocks and things like that, inflation is making that actual dollar value come down as we print more money because we're not on the gold standard anymore. So you have to fight this thing, and that's why when you feel like, oh, you're getting a certain amount of return on your money, it'll be okay. Most people forget to factor in inflation. They wonder why, when they get older, it doesn't look like they could retire or even go part-time. So as you can see here, by the way, this is just inflation at 8.5%. I have another chart, which if you guys are on my email newsletter, you'll get it. We show how inflation has affected different types of commodities. When the government reports inflation, they choose what they want to report. Maybe, this bucket over here, this bucket over there. But either way, it was almost double digits here. They say it's come down now to maybe in the threes, maybe high twos. But if you bought any food recently or gone to a restaurant or paid for gas, it's much more than 3% interest, and everybody knows what's going on with rents and the price of housing and all that stuff. So it's probably underplayed what inflation is doing. So now if you look at some things that are beating inflation, if inflation at the peak a few years ago is 8.5, you definitely want something that will eventually beat something in the eights, because the amount of actual wealth you're building is going to be the difference of inflation and what you're actually making or what you're actually compounding out. And so basically this drop in purchasing power of your currency, it decreases over time. And we talked about with the coffee example, price versus value. Values like the house, the intrinsic value is that it provides shelter. A cup of water is like a certain amount of hydration or a certain amount of flavor if you put anything in it. So that value doesn't really change over time, but the price does. And so they say it's about 3% from 1914 and now. Recently it's been a little bit higher, and the government just likes to wipe out their debts by printing money, but then we're sometimes left holding the bag or having to delay going part-time or retire or anything else you might want to do with your money. So how do you beat it? Well, the simple math is you got to get returns that are greater than the actual inflation, right? And so you have the nominal rate of return, which let's say your portfolio is doing 10%. So 10%, 10%, 10%. That's your nominal rate of return, but your real rate of return, you got to cut out inflation. So let's say inflation is 3%, but you're making 10, so 10 minus 3 is 7. That's actually what you're making. And if you do that across all of your investments over the years, this could mean that depending on how much you're making above or at inflation, you might have to double the time. If you think you might retire in 10 years, maybe it might be 20. If you think it would be done in 20 years, it might be 40. So you kind of have to calculate this carefully and make sure that you're beating it. So this is just mentioning that the nominal rate of return, the real rate of return is actually calculated with, what you're investing in. Let's say if you invest in a bond, but inflation is 8, your rate of return is actually negative. So that's not a good thing. Maybe peer-to-peer loans are 7%, but inflation was 8, you still lost 1. So we got to do something better than trying to break even or be negative. So some inflation hedges that I like: private credit, private equity, which just means private businesses, and then some hard assets like real estate or other commodities. So these are really good because these things a lot of times adjust with inflation. Why? Well, if inflation goes up and the dollar's not worth as much, you can sometimes charge more interest rates. Right now we're actually in a higher interest rate environment. You can actually charge higher interest rates for the same type of lendings. So businesses adjust for inflation because whatever services they provide or the goods they provide they just charge more as the value of the dollar goes down. So the businesses are hedges against inflation. And the cost of actually building real estate or anything like that is going to go up because people had to charge more because the value of the dollar comes down. What doesn't adjust is actually the dollars in your bank account. That just kind of sits there and loses value. So sitting on cash, a lot of times you're going to lose money to inflation. 3 to 8% is what you're losing if you're sitting on money. So that's why you kind of got to keep, moving the money and kind of playing this investment game. So now, what is an actual promissory note? So a lot of people use the terms, but let's look at what the real definition is. So it's basically like it's a repayment of debt, a promise to repay some debt. And in the paperwork, they're going to have certain terms like, okay, here's the rate. Maybe it's 10%, 12%. It's going to start October 1st. It's going to end 3 years in October 1st. You could have some secured and some unsecured. So that means, is there any collateral behind it or not? And then it happens to just be ideal for a lot of retirement accounts too. You can just compound this thing to infinity if you want. And custodians that allow you to self-direct your IRA into alternative investments, they actually really like this stuff. So it's one of the favorites for people that self-direct their IRAs. So how do most people do it? A lot of you have heard of hard money lending. So a lot of fix and flippers, like you see on those shows, most of the time, if they're not going all cash, they're getting a hard money loan, which can be anywhere from 10, 12, even 15%. There's performing real estate notes, so people flip notes against real estate. There's non-performing notes, which that's almost like a business. You have to buy the non-performing one and work to make it performing. Treasury notes, peer-to-peer lending, where you could lend to other individuals, and there's small business lending. So a lot of you guys are familiar with small business loans. So that's basically like similar to a corporate bond. So why would you want to invest in promissory notes? Well, it's one of the most passive investments you can get. You don't have to lift a finger or do anything, right? So if you want to live your life and just have something making, ideally double-digit returns, this is the way to go. It's pretty simple and easy to understand. These things are not 200 pages. It usually can be like 1 to 3 pages, maybe 5. And the return's pretty predictable because whatever it says in the agreement, that's what it has to be. So you don't have to worry about something going up and down, or it's not tied to the market. So it's just basically a fixed interest rate, and it's compatible with your IRA. And at the end of the promissory notes, you're taxed at capital gains instead of your ordinary income bracket. So that might save you, depending on your bracket, up to 19% on taxes. So you have to think, what are you guys doing to protect yourself and your savings? Here's some examples of traditional investments here. So even past stock markets, if promissory notes can pay up to 15% and possibly more if somebody wants to do a big JV and take out a whole project, which could be 1 to 3 million. It could be even more in that case with a promissory note plus equity kicker. So what have we done? So people have asked us, hey, how do we get involved in promissory notes with Baluch Capital? Well, we have anywhere from 12, 18%, reserved for some of our JV partners. It's passive, predictable, low default rates, and you could diversify from traditional investments like we had on the other slide. And it's backed by a hard asset, which in this case is real estate. Here's another example. It doesn't always have to be real estate that it's backed. You could also back it with inventory. So we have an inventory lending fund. That's called Nobility Lending. And we got featured on Ameritrade and Business Insider for that. And that was a pretty niche thing that we did. A lot of people more familiar with the real estate. So this is an example of something we're actually building right now. So these are some attached townhomes, which technically makes it multifamily because it's more than 4 in a row. And we always use something that has an advantage in the area. So, in one area we might have land that's 33% bigger. We'd have pretty conservative underwriting. We use older comps that might even be 10 years old. Of course, a new house is going to sell for more than that, right? So we just like to be conservative. There's usually no competing areas when they're in there, and multiple ways in the project to exit. You could sell, you could refi, you could keep it as a turnkey renter. So some people actually want to buy these for themselves. So we have that program too, where you could start out as a promissory note and get your interest, and then when you get cashed out, you turn around and buy it right into the house, and that your gain can be used to put equity into the home. So you basically coming in on day one with maybe 10, 20, 30% discount on a home before you rent it yourself. So not everybody can invest in these all the time. There's exceptions. Usually we only work with accredited investors, which means $200,000 of personal income. If you're married, $300,000, or if you don't meet any of these criteria, if you have $1 million net worth. And recently, if you do have a Series 65, which you can get, with a couple of weeks of studying, that can make you an accredited investor as well. So if somebody's interested in avoiding inflation and using promissory notes and wants to take the conversation further, this is just kind of a general explanation of inflation and some hedges. You can join our Wealth Circle. If you're not in there already, you could just email me. We can talk about your situation. You could book a call with me or somebody on my team, and we'll see if this makes sense in your portfolio depending on what your goals are and what your timeline is. We could very briefly kind of look at your tax situation and see how this can help you, or sometimes we could actually modify the notes to make it more beneficial. That's a conversation we've got to have one-on-one there. And we look at the timing. Is this a time for you to get in or not? Some people, if you have access to the portal, these things are already in here. And if you guys have your camera, you could scan some of these things. We do have some free gifts for people that come on these webinars and take time with us. And if you want to just book a chat with me and ask the questions that you've been dying to ask, you go ahead and do that. So here you have it, promissory notes and how to hedge against inflation. This is just one way to do it. It just happens to be very popular right now at these times of high interest rates and high inflation. So thanks you guys for watching. If you have any questions, just reach out to me on one of these QR codes. Reach out to me on LinkedIn, Instagram, or you could email me at amir@baluchcapital.com.